Hello, everybody, and welcome to the next panel. We're going to be talking about tokens, coins, and above, the rise of the security and stablecoin. And we have been having a quick chat in the back about the things that we're going to talk about. It's going to be exciting. We don't have that much time. So the first thing I'm going to do before we get into the meat of this is I want to go do a quick introduction with everybody. Very quick, keep it about 30 seconds. 45 if you want to push it, and tell us a quick piece of your background and why this panel was where you ended up. Let's start over here with Grace.
Sure. So my name is Grace. I'm from the regulatory team at Herbert Freehills, and I cover Singapore and Hong Kong, and my specialty focus is fintech, and I've been supporting a lot of digital asset exchanges, token projects here in Asia. In my previous life, I spent 5 years with the MAS in Singapore.
Hi, everyone. I'm John Fiorelli. I'm the Chief Growth Officer at Kenetic. We're based in Hong Kong. We advise projects, some of which are still alive, not dead ICOs, amazing. We invest, we do treasury management, OTC, and we also provide liquidity for projects and exchanges. I've had the pleasure of advising on projects like Bluezell, Mainframe, Simple Token, and also Shares Post Glass and Caspian. And I'm very excited about the topic today because we're talking about things that are the future and perhaps the near future. So,
I'm Kingsley Advani, founder and partner at Chainfund Capital. We're a $20 million crypto fund with offices in San Francisco, Singapore, and London. We've made around 30 investments in projects across scalability infrastructure like Zilliqa, Thunder, Oasis. We've invested in institutional infrastructure, security tokens, and gaming.
My name is Sam Bankman-Fried. I'm a CEO and founder at Alameda Research. We are a quant fund in crypto. We trade about $150 million a day worldwide across exchanges and also OTC, and are one of the primary liquidity providers in stablecoins across basically all exchanges.
All right, awesome. And I'm Brent. I'm the host of the CryptoBasic podcast, and I'm good at asking follow-up questions, so that's my qualification. All right, so going forward, we're going to do some questions amongst each other, and then hopefully we'll have a little bit of time for audience questions towards the end. And I wanted to start out with kind of tying this into the previous panel. They were talking about the death of the ICO, and we're talking about stablecoins and STOs. So I wanted to ask the question to you, Sam. If ICOs had raised stablecoins instead of Ethereum, I want to have a thought experiment here, and what would have happened differently? Would we have been through that same meteoric rise in the market, or what do you think?
It would have been boring, and that would have been great for markets. Instead of having this insane run-up as people desperately bought Ethereum to send these ICOs, followed by a year later an insane crash as all these ICO projects desperately sold all their Ethereum way after they should have. If they just raised in Tether at the time or now, Tether or any of the new ERC20 stablecoins, there would have been basically no market impact on either side of that. It would have kept markets way more orderly. It would have stopped this massive reserve of Ethereum that was going to be dumped at some point if prices went down enough. And from the ICO's perspective, it's fucking insane to raise $1 billion and then decide to keep 100% of it in a 300% annualized volatility asset no one really understands and just hope it really goes up. And obviously they're paying the price for that now, but it would have been way better for them if they hadn't exposed themselves to every dollar they'd ever made in Ethereum.
So I'm wondering, do you think that the answer was closer to keeping some sort of balance, or maybe keeping, should they have, given that they didn't raise stablecoins, should they have kept more in stablecoins?
I think just 100%. They're totally separate businesses, right? Are you in the business of creating a company and selling tokens on it, or are you in the business of buying a lot of Ethereum and hoping it goes up? And there's no reason those have to be the same business. There's no reason that ICOs had to have any Ethereum in their treasuries. Unless you're telling Bill Gates that he should own an enormous amount of Ethereum, which maybe you are, but that just seems totally separate to me from having an ICO.
I think when many projects raise, there wasn't as big a variety of stablecoins to pick from. So only recently we've had really good infrastructure coming out to be able to have good stores of value with stablecoins. So many projects didn't have the luxury of all of the current stablecoins.
Do you see the multiple varieties of stablecoins as kind of a really good thing because the competition is going to force them to be the best stablecoin?
Yeah, I think there's different variations of stablecoins. So we've got fiat collateralized stablecoins, crypto collateralized, and algorithmic, and asset-backed as well. So I think that given there's a wide variety, it takes the pressure off any given stablecoin. For example, maybe a year ago or 2 years ago, Tether would have had the majority of the strain of the network, but nowadays we can see volume going into multiple different stablecoins, which takes away a single point of failure.
And to be clear, Tether still is like 90% of the market. So it's slightly less than it was a few years ago. But talking about things that are too big to fail in crypto right now, Tether is #1.
Yeah, and I would add to that as well. And I do think that there are quite a lot of new stable coins emerging in the market. So in Asia, I see quite a lot, practically one a week emerging, and a lot of the exchanges have launched their own stable coins as well. So I think it's also a question of whether it's good to really have 200 stable coins emerging in the market in terms of counterparty risk, in terms of the value add that a lot of these stable coins are really presenting. And for the legal aspect as well, here in Asia, the analysis might not be so straightforward. So we were talking about some of the stable coins previously on how they have elements of a bond coin, and they offer that bond coin in order to buy back a sort of debenture or debt product, and that might constitute a security here in Asia. And there are also aspects of stable coins falling within the concept of e-money in Japan or in other markets, and those are aspects which are not here to not have been really discussed and debated in this part of Asia as yet. Yeah.
Well, I think that there are a handful of new tokens that are stablecoins that have been adopted that exchanges are supporting between Coinbase and Binance. Mm-hmm. But there are a few differentiators. One is the quality of the custody and making sure that these prove out to be secure. So, USDC, Geminis, those are ones that have at least fairly proven custody, but they need to be auditable. Mm-hmm. And we don't have enough history with these. So the second is that do each of the coins have sufficient liquidity? Some of them have really good market cap, but not a lot of good trading volume. And so we have pretty wide spreads on some of these tokens. So it's true, we could have raised in a stablecoin environment now, more so, and it would be more stable than it would have been, imagine everyone selling off all their Tether at the same time. Smoother than Ethereum, smoother. I think hindsight is 20/20. We could have raised in Bitcoin, and maybe that would have made things smoother. But at the end of the day, what do we raise with now? And I think one of the topics I know we're going to talk about is how do we raise for security tokens? What do we raise with now?
I think Trust Token, USDC, those are fine answers to that.
Mm-hmm.
And to go to a point about counterparty risk, that's fucking massive in stable coins. And this also goes to liquidity. What gets rid of counterparty risk and increases liquidity? It's redeemability. That's the one thing that matters for a stablecoin. Is the day that you go to that company and you say, I've got half your entire market cap and I need to redeem it today. They say, yes, that is fine with us and we're not pissed. That's the thing that makes a stablecoin really stable. And that's the thing that allows us to be willing to buy enormous amounts of it at 99.5 cents on the dollar, no matter how much people are dumping, if we know that we'll be able to redeem that. If we're scared about that, all of a sudden the bottom can fall out.
You had mentioned that the volume for a stablecoin really mattered with regard to which one we should use and why we should use it. In theory, if it's doing its job properly, the volume shouldn't shift the price. So what is the relationship between volume and necessity for?
Just like any other token, you care about getting in and you care about getting out, right? And if there isn't enough, I guess you could say, if the spreads are really wide, if there isn't enough depth in the order book, just like any other token, it's not as stable as you think, because people aren't going to redeem their tokens for cash right now, not in practice, not to the degree that it makes a difference in an exchange. So yes, at Kenetic, we think that we would really like to see tokens have more robust volume and be able to essentially provide a stable market. That provides confidence over time.
So would you say that the massive amount of stablecoins that are popping up is then a bad thing? The competition is actually might be hurting the...
No, I mean, competition I think is a good thing at the beginning. And having these spreads at the beginning is not something to make us quake in our shoes. But over time, I think we want tighter spreads. I mean, if this is truly going to be stable, we're not looking at 4 or 5% spreads. We're looking at something much, much tighter to $1.
What stable coins are you looking at with 4% spreads?
Well, let's put it this way. When some of these first launched, and I don't think this will be the last time we see, maybe not USD backed, but how many of you are interested in algorithmic stablecoins?
Yeah, I mean, algorithmic stablecoins are totally fucked. I agree with that.
Yeah, so I think if the purpose of a stablecoin is not merely to be a crypto asset, but actually be a product, right? I mean, because that's what it is, isn't it? Isn't a stablecoin really more of a product? That's how we see it.
Can you give us like the elevator pitch for an algorithmic stablecoin? Just for if anyone in the audience might not be familiar.
Yeah, I mean, essentially, actually, I don't feel like I'm qualified to give that kind of elevator pitch. We've received them from projects like Basis that I think have done a really good job of explaining what they do. I don't think I'd be the right expert to explain that, but I think the real question is, if you're going to buy a stable coin as a store of value, how do you feel confidence that it will maintain that price? How many of you have used a stable coin at some point in the past 2 weeks? So that's pretty telling that we don't see it as a stable enough place to, unless you're all speculating. You're all hoping that everything's going to turn around, right? How many of you think it's going to turn around in the next week? Okay, so that's also telling. So I think there's a gap between what even the USD-backed tokens should be doing and what they're really offering as a product.
Yeah. And there are a lot of these new commodity-backed tokens as well, and there have been issues associated with gold and the purity of gold and issues around the redeemability. Because you are right to point out that it's a very essential aspect of a stablecoin, but if you're going to take 10 weeks to redeem it, what's the point, right? So,
Yeah, completely agree with that.
Yeah.
And yeah, you look at these stablecoins with no liquidity. Like, I can tell you what's going on there. We're not bidding for them because we don't think we can redeem. And you look at the stablecoins with a lot of liquidity in them in markets, we're willing, we're making markets way more liquid in them because we're confident we can redeem those. And I think that really it is redeemability flowing through to liquidity in markets there.
If we're talking about redeemability of a stablecoin, I would probably argue that the US dollar is a really terrible stablecoin for the US dollar. It would, if everyone tried to redeem their US dollar note at the same day, they wouldn't be able to do so. So I'm wondering, where is the balance with redeemability and usability? Because Tether is supposed to be 100% backed, and so are all of these others. But how long before they're not, and what happens if they're not? And does it ever come crashing down?
Yeah, I mean, it's a good question. And the first thing I'd like to say is Tether is 100% backed. It's basically just trolls on the internet saying otherwise. But redeemability is a really important issue, and you can be 100% backed and still only dubiously redeemable. And it will not come crashing down if it is redeemable, because people will provide liquidity backstops and redeem it. But if it's only dubiously redeemable, yeah, someone tries to sell half the market cap of the thing, no one can fucking buy it, right? You can't redeem it. Like, what you call a coin that you can't redeem for anything and is not backing a company worth any value, like, that's just a shitcoin. And so, that's a pretty big issue. And like, a lot of these algorithmic stablecoins are just not redeemable, even in theory. I think MakerDAO, still has not implemented redemptions, basically. But others like Gemini Dollar is basically not redeemable, as it turns out.
We see stablecoins as still quite early. We're more interested in the future applications of stablecoins. For instance, if you had a universal basic income. So we're helping a project at the moment called Good Money, and they want to be able to provide the world with a universal basic income. And this is actually possible with stablecoins. So because there's no kind of capital restrictions on stablecoins, and they're very liquid across the world, you could provide a family in Uganda with a basic wage. It also enables things like cross-border decentralized loans. So you could lend electricity, for example, to a family in Kenya. So there's a lot of future applications with stablecoins, although I think we're still early in getting that.
Okay, so which part of the future application has you just, if you could pick one to be the most excited about?
I don't think we know what will be the killer app for stablecoins. I think that, firstly, we need the infrastructure to deliver good stablecoins. And secondly, we need developers to be able to play with the technology, to be able to build really cool applications. So far we've seen things like decentralized lending, cross-border, and things like universal basic income. They're quite interesting at the moment because, for instance, if you're trying to send money overseas, you do have capital restrictions in certain countries. One other application is just a store of value. So say, for example, in Argentina or Venezuela, you can have rapid currency fluctuations. And a stablecoin makes more sense as a store of value rather than these countries' currencies.
I do want to switch the panel over to STOs in a second. But Sam, you said one thing about Tether that I wanted to just, that I put on the back burner I wanted to talk about real quick. You said they were 100% backed.
Yes.
And they say that when we talk about signaling theory, the easiest way to prove something is usually what you're going to go with. And if you don't choose that method and you choose a more difficult method, it lends some doubt over top of the entire thing. So why hasn't Tether done the easy audit? And since they haven't, how do you marry that with they're definitely 100%?
Yeah, they've got serious regulatory issues. Like, they pissed the hell out of US regulators. They've gotten somewhat blackballed by US banks. And the result of this is that lots of major financial institutions, including auditors, including large US banks, do not want to touch Tether, do not want to touch any wire transfers from Tether, and do not want their name associated with Tether in a formal audit. I've talked to auditors from major accounting firms who have audited Tether and said, yes, it checks out, but I was not allowed to publish this audit because some combination of my firm and the bank did not want their names in a press release associated with Tether.
Wow, that's interesting. So there may be audits out there, but your argument is that they're just not being allowed to publish those.
Yeah, and Deltec is probably the closest that's happened, where the bank they're currently banking with, the president of the bank, sent a letter saying they're fully backed. Here's the reserves, actually a little bit bigger than the number of Tethers. And this has been confirmed by a lot of different parties who have looked at that account, including major cryptocurrency exchanges, including many banks, including auditors. But because of the really hot water that Tether got in regulatorily, they've had a lot of trouble both getting anyone to vouch for them and being able to really move money around the world in terms of banking.
I think it might be very good for them to, I don't know, say that. Say, hey, we want to give an audit, but we're having trouble. All right, so we'll go to STOs because we do have two very important topics in the panel. And when I personally hear STO, because I know very little about them, I hear a regulated ICO, which is not what they are. It's just the first thing I think of when I say that, and that may be the first thing that others think of when they say that. So, so Kingsley, I know we were talking in the back. That is a very poor definition. So what would be your kind of best definition for something like that?
Yeah, so security tokens are a huge opportunity. It's basically the opportunity to migrate traditional assets to the blockchain. So we're talking about assets that are far greater than utility tokens. For example, total global real estate. Does anyone in the audience know the total value of global real estate?
Yeah.
Sorry? 360 trillion. Yes.
That's about right.
I read about 217 trillion, but would say anywhere between that. So I think if you could imagine if global real estate was on the blockchain, what a tremendous opportunity that would be. For instance, if Sam and I wanted to buy a house together, instead of amassing 100 pages of paperwork, we could just both partake in a security token, and we could have our ownership of a house stored in the security token. And we could easily contribute the ETH or the US dollars or the stablecoin to be able to buy that house. And if you multiply this on a bigger scale, we've also got the whole art market. We could have fractional ownership of art. We can have securitized derivatives. We can have commodities. We can have equities. Everything, any traditional asset can be securitized, and this is a huge opportunity.
So the regulations for something like that seem pretty clear, right? Like we know exactly where we're going with these STOs, and we don't have any uncertainty. Correct, Grace?
Well, I would beg to defer, actually. So I think the very interesting thing, and I've been speaking about security token offerings a lot in Asia. I attend a lot of the conferences. It's currently the rage word, the word which is out there in the market right now. And the interesting thing, I think, is that a lot of the discussion on security tokens has really revolved around the US market. And that is pretty much because of what the SEC said about how almost none of the tokens they've seen out there in the market is not security. And you compare that to the Monetary Authority of Singapore in consensus, where they said they have not seen a single security token offering in Singapore. So it's really quite different. A lot of the utility token, the ICOs in US were on hold because of the whole subpoenas being issued, a lot of ICOs being issued without the required registrations. And now quite a lot of the past ICOs that went unregulated are now opting to be under the regulated sphere, under Regulation D, Regulation S, other types of regulations in the US. But here in Asia, a lot of ICOs were being launched as essentially utility tokens, i.e. you get a token which you have a mode to a platform and you're able to use it, and therefore it was thought to be outside the scope of a share, which is equity offering in a company, a debenture, which is debt product, or a collective investment scheme, which is a fund product. But gradually, because there's a greater focus on reaching the institutionalized markets here in Singapore, Hong Kong, Korea, and Japan, for example, therefore the focus was really how you can develop products in line with the traditional securities regulations here in Asia to actually offer these to a greater pool of investors. And there's a lot of talk about that, but I think the supporting infrastructure is very important. I think I had a discussion with Kingsley just now about how in terms of platforms offering security tokens, there's still quite a lot of players which are operating unregulated in the markets, although I do feel that the Asian regulators have been very clear on their view that these platforms are meant to be regulated, but there's still a lot of differing opinions out there in this space. Yeah.
Yeah, it's interesting because the SFC just gave some initial guidelines on what a sandbox might look like, whether it be for platforms, for exchanges, for funds to operate and be regulated. But I think it's still it's still a little nebulous because I think regulators are still trying to understand themselves what the opportunity is in the tokenization of what is already regulated. So then the question is, well, what should be tokenized? And as Kingsley said, you can tokenize real estate, you could tokenize a building, you both can buy one together. But what is from a UX standpoint, what is the opportunity to invest in one building? When does it get interesting? Does it become more interesting when it's 10 buildings or 100 buildings because you can spread risk? So what is interesting to actually invest in? Because there's still a gap for traditional real estate investors in terms of investing in crypto. They're not necessarily en masse ready to invest in a token, but they are interested in still investing in REITs or in some type of collective. So I think that's a question that I still have, is what's worthwhile. And the second question is, well, let's say we tokenize some really wonderful assets or projects that have raised money with stablecoins. And well, where are they going to find liquidity? There aren't really great venues. We can certainly have platforms that could tokenize them, but where do you find the liquidity to buy and sell and get in and out of these assets? Otherwise, why are we tokenizing? So one project that Kenetic got into earlier in 2018, when nobody was talking about security tokens at all, is a project called Shares Post Glass. GLASS stands for Global Liquidity and Settlement System. The intention of GLASS is to be a network of exchanges that allow exchanges to basically share compliance and ultimately order booking of ideally security tokens that people are interested in. And so for us at Kenetic, I think one of the things that we're really interested in is where are the exchanges going to be that can actually achieve liquidity, and how can they work together to accelerate the growth of the space? Because if it's growing at the pace that we're seeing right now, and if we don't collaborate, this could take a long time to be interesting.
That's interesting. So you're saying the collaboration is significantly more important than the competition?
Right now, yes. I think we need to find ways to be creative together. I think we need to find ways to accelerate trade amongst each other. I think taking a very siloed approach to providing an exchange stack is a slower way to accelerate the space. Imagine everything getting tokenized. Imagine every company offering various classes of tokenized equity with different rights. Imagine the incredible proliferation of creative token creation. And now imagine who's going to trade all that, right? So we need to have some measure of thinking about what are the best practices for rights, what kind of underlying value is really worth tokenizing and having liquidity for. Not everything is a fit. And so these are questions that we're asking now.
I agree. Right now, as a security token investor, there's limited liquidity. So at Chainfund Capital, we hold a few security tokens in different projects, and you can't trade them on Binance or on Coinbase or on Huobi. So yeah, right now there is limited liquidity, but the future liquidity is exponential. So security tokens in the future, we would see them listed on exchanges like New York Stock Exchange, Gibraltar Stock Exchange, Malta Stock Exchange, the London Stock Exchange. I know who are doing a pilot at the moment. So actually, the future liquidity will be 1,000x, 10,000x bigger than in crypto at the moment. But right now, there is limited liquidity. The second point, you talked about rights. I think a great application or great use case for security tokens is embedding all of the rights of traditional equity, for example. So you'd have shareholder voting in the security token. You could have dividends in the security token. You could have vesting in the security token. So all of these kind of formal contracts that are traditionally written on paper, you can have programmable. So that means that you don't need a team of accountants or lawyers to be able to enforce, for example, shareholder voting. You can simply have it automated through a smart contract. So I'm particularly excited about the programmable side of security tokens.
So where do you think it's important to start? Do we start at owning, say, like a really famous building, the Empire State Building or something? Or do we start with like a Generation Zero CryptoKitty?
So for right now, we're in the infrastructure stage of security tokens. So we have a lot of the platforms like T0, Polymath, Harbor, Securitize. We have a lot of the platforms building the infrastructure to issue security tokens. So you also mentioned as well, how do you invest in this space at the moment? It's quite interesting to invest, I think, in equity in security token platforms. We personally, we invested in Polymath back in 2017. So yeah, right now we're in the infrastructure stage. In terms of investing in security tokens, we haven't seen like a huge performance from a security token yet because we simply don't have the exchanges yet. Although I do think next year we will see security tokens starting to get listed on top exchanges.
Yeah. I would add that based on our experience, because we have been working with some of these security token exchange platforms, and I think some key challenges include secondary market liquidity, because once you have your token out there, you must have some sort of smart contract or some kind of security to make sure that the tokens remain within the professional investor market, because that is part of the regulatory expectations out there in the market. And also for KYC, AML, Know Your Client, anti-money laundering regulations. This is something which varies amongst different countries. So I know that some of the models like Polymath, Securitize, they do work with other providers to understand some of the regulations globally. But currently, you do not really have providers who have covered the entire scope of the market. And especially for institutional, for corporate entities, the KYC, AML regulations are notoriously difficult. I think even for financial institutions which have been there for many years. They still struggle with this on a very daily basis. So those are issues which a lot of these platforms will face. I remember speaking with Polymath, and they mentioned that essentially they do not conduct KYC on the issuers which get on the platform, but gradually with greater regulatory pressure, it's also an interesting question on what regulators will expect out of issuance platforms such as Polymath and what they expect out of platforms operating in Gibraltar, US, elsewhere, and offering basically some of these new securities to Asian markets.
Which part of the regulatory uncertainty do you see as kind of like the white whale? Like if we can get this figured out, this is really going to help with regard to STOs. This is like the one thing. I mean, I'm sure there isn't one, but if you could pick your favorite.
So the one thing which will make it work? Or?
Well, which is the toughest regulation to, right now it's uncertain between country A and country B. Mm-hmm. When everyone gets on the same page with this, we're going to be able to have smooth sailing with regard to launching these STO products. Is there any kind of blockage there? Or
yeah, I think one of the difficult points currently with the Hong Kong SFC example, so just to share and build on what John was sharing, the SFC in Hong Kong, the regulator, issued a conceptual framework for sandbox for exchanges, so for security token exchanges to be launched, but they did set out a very long list of detailed requirements which are actually higher, I think, sometimes than financial institutions to follow. And one of it is, for example, that you are only able to list security tokens 1 year after the ICO has launched, so there's a specific holding period. There are certain KYC AML regulations which extend to secondary markets, and suitability. So suitability is something which the Hong Kong regulators have really stressed on. And when it comes to crypto markets, the regulator has not really stated what kind of product would be considered as complex or suitable for your markets. So in Hong Kong, this is the kind of test that will apply for a security token exchange. But in Singapore and Thailand, in different countries, that will be quite different. So consistency in regulatory frameworks, I think, is the main challenge. And if different regulators are able to come together and come up with a more base framework on some of these understanding, perhaps through IOSCO or through FedF and different types of industry bodies, I think this is what is needed to make this whole concept work for securitization.
That's exciting. We are getting close to the end of the panel. I was going to continue that discussion, but I did promise some audience questions, some audience participation. So as you're thinking of a question you may have, I want to ask the audience, since we touched on Tether, how many of you believe that Tether is safe and 100% backed? I don't even need to ask the second part of that question. So that's, I wanted to just I thought that might have been the case. I actually would have lost the bet on the percentage.
I thought you believed it then.
Oh, yeah.
Wait, you didn't raise your hand. All right, so let's ask a couple of questions, and we got one right here.
Yeah, so Tether, which auditor did you speak to? Yeah.
I don't actually want to give away their name.
No, you should, though. I mean, you're up here talking about it.
I mean, they very intentionally.
So who was it?
Like, as I said, like, the context was that they and their firm did not feel comfortable publicly associating their name.
But they were
with
fine
this.
talking to you, even though you're an unrelated third party? You expect me to believe that? Right, whatever.
No,
if you believe in Tether, why aren't you squeezing it up to par? Like, why is it traded at 98.5?
Because they are in really difficult waters in terms of banking relations and regulatory framework. It is not easy to send a wire transfer associated with a Tether redemption across the world. If you're trying to do that, you have to go through
No, but what I'm asking is, why can't you just squeeze the price up to par?
Well, what are we going to do? Just buy a billion Tether and then hold it forever? We have to redeem it. And it's hard to redeem a billion Tether because you're trying to send $1 billion worth of wire transfers through a lot of international banks.
There's only one, though, right? There's a scam bank in, like, the Bahamas?
Well, sure, you can get the money there, but if you want to get it out of that bank, you're going to have to go through, for instance, a U.S. clearing bank if you want to get it to a different country.
Right.
And there you start to see the problem, which is that it's not easy to move $1 billion of a thing which a lot of banks don't want to touch.
So they have $1.7 billion or whatever that they can't use.
Well, I wouldn't say they can't use it. I would say
Well,
that
what can they use it for?
All right. We got it. That was adversarial. It was kind of fun. But I will stop you there. We'll keep going forward. Hopefully the next question will be nice.
I'm not talking to auditors at all.
Yeah.
Any regulators in the room? No.
Not talking to auditors.
All right, does anybody else want to follow that particular question? Any more? We can keep talking. I can probably spur us forward, but all right, I don't see any hands. So let's kind of bring it. Let's go back to the security token offerings and think about the most exciting piece of what a security token offering, not in the near future. Let's think about 10 years from now. And you're looking back on this part of the space, the security token offerings that started, but now you're looking at the ones that are there 10 years from now. What is the most exciting part? And obviously that's a crazy thought experiment, but I wanted to go with you, Kingsley.
I'm pretty interested in programmable rights. So for instance, if we all had shares in Facebook, we could potentially vote on what we want to see at the company. And if you multiply this across different assets, I think programmable rights, really, there's so many different applications. Even for companies that we're investing in as utility tokens, you can imagine instead of investing in utility tokens, you'd get security tokens, and everyone would be a shareholder of the company. So potentially we could have kind of like a majority vote on what we want to see happen at the company. I'm also interested in things like programmable dividends. So for instance, you wouldn't need teams of accountants or lawyers calculating the dividend. You just have a smart contract automatically issuing the dividend. So yeah, particularly interested in programmable rights with security tokens.
I would agree with programmable rights. You took my favorite, so I agree. But so as not to be a copycat, I would say that I'm also really interested and cautious/scared about the idea of having more retail investors participating in very liquid equity, liquid rights in different companies, or even in assets. The idea that I'm really interested in how we can close the UX gap for everyday investors who want to participate in a variety of asset classes that they currently can't get into because they're not accredited or professional investors. So that's something that interests me a lot, is what is the UX to playing in the space?
Yeah, for me, I would add that perhaps it is a common KYC utility. So the idea is that once you have been cleared to invest in a particular coin, because of your certain profile, which is captured by exchange and perhaps shared between the different exchanges, you can essentially go on to another platform easily and sign up and review and perpetually buy that token immediately. So I think there's great potential for that as well.
And all right, I don't know if it's okay to talk to you finally, but did you have any thoughts on the cool future of the STOs?
I mean, obviously, it's a gigantic market opportunity if you can tokenize the whole world. Now, query at some point, why are you doing that? Like, what's wrong with just normal securities? What do you get from tokenizing it? And I think when you look at something like tokenizing a single building, the answer is nothing. Like, it's not like the world's a lot better if there's a token representing like some gigantic skyscraper in New York, because it's not like that thing's gonna be changing hands a lot. And it's gonna be important that like an anonymous party can spend $5 billion to buy a building. But I think when you start to look at things like, distributed portfolios, owning partial shares and things, I think that's a case where blockchain technology allows simple, fast transfers of assets across the world starts to look, a lot more attractive. And I think a lot of ETF type instruments actually make a lot of sense to have a, blockchain counterpart for.
All right, that was a perfect way to kind of end the panel, get everything ready. We've got 40 total seconds left, so I don't want to start and open up another rabbit hole. That was kind of the quick overview of the rise of the STO, how it relates to stablecoins. Obviously, there's a lot to talk about. Everyone here will be around the conference, so please don't hesitate, for the most part, to come up to them and have a conversation. And I will be around also. You're going to get to meet my co-host here in about 15 seconds. He's a much more well-spoken, more attractive version of myself. So I'm excited to have him come up here.